BTC, leaning towards accumulation, but with profit-taking pressure. Some reports indicate that BTC whales are still net buyers, while the amount of BTC being added to exchanges is increasing as the price approaches resistance. The flow of BTC from large wallets to exchanges is usually a short-term sell signal. 60-minute scenario, 55%. Sideway to slight increase, 45%. Rapid sell-off if selling volume increases. ETH, whale selling pressure is increasing. Many sources report large sell orders from ETH whales and an increase in ETH inflows to exchanges. However, very large whale groups, 10,000 ETH, still show signs of accumulating at medium-term support levels. 6-minute scenario, 60%. Correction or weak sideways movement, 40%. Upward movement if BTC maintains momentum. SOL, higher volatility. According to BTC, recent sources haven't shown any whale signals indicating SOL is more prominent than BTC ETH. SOL usually reacts more strongly when BTC has a breakout. 60-minute scenario. If BTC is green, SOL usually outperforms. If BTC is rejected at resistance, SOL may fall more sharply than BTC. Why do institutions often prefer Bitcoin, BTC? Because of its highest liquidity? In the cryptocurrency market, there are thousands of different coins, from Ethereum and Solana to a host of new altcoins appearing every day. However, when it comes to the flow of funds from large institutions such as investment funds, banks, asset management companies, or professional traders, Bitcoin remains the top choice. So what makes institutions prefer Bitcoin over most other crypto assets? The answer lies in one extremely important factor: liquidity. In today's video, we will explore what liquidity is, why it is important, and why Bitcoin always holds the #1 position in the eyes of institutional investors. What is liquidity? Liquidity is the ability to buy or sell an asset in large volumes without significantly changing the asset's price. Example: if you want to buy $100 worth of Bitcoin, the transaction is almost instantly matched. But if an investment fund wants to buy a 100 million worth of a small coin, the price could surge just because of that buy order. This creates a problem called slippage. Institutions managing very large amounts of capital are particularly concerned about the ability to enter and exit the market efficiently. Higher liquidity, lower bid-ask spread, faster order execution, lower transaction costs, lower operational risk. That's why liquidity is always a top priority. Bitcoin has the highest liquidity in the market. Bitcoin is the world's first and largest crypto asset. BTC accounts for a significant portion of the total market capitalization of all cryptocurrencies. Billions of dollars are traded daily on centralized exchanges, OTC markets, derivative exchanges, Bitcoin ETFs. Bitcoin's order book depth is superior to most altcoins. This means an institution can buy or sell very large amounts of BTC without causing significant price volatility. This is a crucial advantage for investors managing hundreds of millions or billions of dollars. Institutions need stability. Many people think that institutions only care about profit. In reality, they also care about risk management, transparency, custodial capacity, legal compliance. Bitcoin meets these criteria better than most other cryptocurrencies. Compared to smaller altcoins, BTC has a longer operating history, a more decentralized network, easier to be accepted by regulators, more supported by financial institutions. This makes Bitcoin a natural choice for institutional capital. The role of derivative markets. Another very important factor is the Bitcoin derivatives market. Institutions don't just buy assets and hold them. They need risk hedging, arbitrage trading. Portfolio management. Bitcoin has a thriving derivatives ecosystem: futures contracts, options, spot ETFs, futures ETFs. This allows institutions to manage risk more effectively. This is something that most altcoins currently cannot achieve on a similar scale. Large amounts of money often flow into BTC first. Observing the history of the crypto market reveals a fairly common pattern. When new money emerges, the first step is usually to flow into Bitcoin. After Bitcoin grows and market sentiment improves, the new money begins to spread to Ethereum. Large-cap altcoins, mid-cap altcoins, higher-risk projects. Therefore, Bitcoin is often seen as the first gateway for institutional capital. In short, the reasons institutions often prioritize Bitcoin are highest market liquidity, lower transaction costs, easier to buy and sell large volumes, more complete custody and legal systems, a thriving derivatives market, considered the safest and most mature crypto asset. In a volatile market like cryptocurrency, liquidity is key to helping institutions protect capital and implement effective investment strategies. And to date, Bitcoin remains the leader in this aspect. Thank you for watching. If you found this content helpful, please share and follow us for more updates on the crypto market. If you've been following the crypto market in recent years, you've probably noticed a very interesting phenomenon. Whenever large sums of money from ETFs, investment funds, or financial institutions enter the market, Bitcoin is almost always the first destination. While thousands of altcoins constantly emerge with promises of new technology, faster speeds, or better scalability, funds managing billions of dollars still prioritize Bitcoin. Why is that? Is Bitcoin truly superior to all altcoins, or is this simply a risk management strategy of large institutions? In today's video, we'll delve into why ETF and asset management funds often focus on Bitcoin before considering other altcoins. Organizational investments are not the same as individual investors. A common misconception is that institutional investors behave the same way as individual investors. The reality is quite different. An individual investor might take on high risks to seek returns of 5 or 10 times their initial investment. But for asset management funds, the number one goal is capital protection. They manage the money of individual clients, pension funds, insurance companies, financial institutions, large corporations. Therefore, every investment decision must be carefully considered. When entering the crypto market, they need an asset that has a long history, is widely recognized, has high liquidity, has the lowest level of risk among digital assets. Bitcoin meets those criteria better than any altcoin. Bitcoin is the most recognized crypto asset. Bitcoin was created in 2009. After more than a decade of operation, Bitcoin has experienced many cycles of rise and fall, financial crises, several crypto market crashes. However, Bitcoin has survived and thrived. In the eyes of institutions, this is an extremely important factor. The longer an asset's history, the higher its credibility. Meanwhile, many altcoins have only been around for a few years. Some projects were once in the top market capitalization but then almost disappeared. This makes institutions more cautious when approaching altcoins. Bitcoin's huge liquidity. Liquidity is a vital factor for large funds. Imagine this. A fund wants to invest $500 million. If they buy an illiquid altcoin, the price could surge immediately after the order is placed. Transaction costs increase significantly. Exiting the position becomes difficult. In contrast to Bitcoin, the daily trading volume is enormous. Market depth is better than most other crypto assets. This allows institutions to buy and sell on a large scale, reduce slippage, manage risk more effectively. This is why institutional capital often focuses on Bitcoin first. ETFs often choose Bitcoin. First, ETFs need to meet many stringent legal requirements. To be approved, the underlying asset must have transparent data, high liquidity, secure custody system, reliable valuation. Bitcoin is the cryptocurrency that best meets these conditions. Therefore, as crypto ETFs develop, Bitcoin is often the first asset chosen. This creates a positive cycle. ETF buys Bitcoin, increased liquidity, increased reliability, more institutions participate. Bitcoin is seen as digital gold. Many asset managers don't view Bitcoin as a transactional currency. They see Bitcoin as a reserve asset, similar to gold. Bitcoin has several outstanding characteristics. Limited supply, cannot be minted arbitrarily. Operates on a decentralized network, capable of long-term value storage. Therefore, many organizations consider Bitcoin a tool for portfolio diversification. Before considering higher-risk altcoins, they often allocate capital to Bitcoin first. Money flows typically in cycles. Observing multiple market cycles reveals money typically moves in the following order: Bitcoin, Ethereum, large-cap altcoins, Mid-cap altcoins, speculative altcoins. This happens because institutional investors often start with the safest assets. As market confidence increases, new capital flows gradually expand to riskier assets. That's why Bitcoin often leads the entire market. In summary, ETF and asset management funds typically focus on Bitcoin before altcoins for 5 main reasons. Bitcoin has the longest operating history. It has the highest liquidity in the crypto market. It is widely recognized by financial institutions. It complies with legal and ETF requirements. It is seen as a form of digital gold for storing value. When large amounts of capital enter the crypto market, Bitcoin is almost always the first destination. And only after Bitcoin stabilizes does the flow of money begin to spread to Ethereum and other altcoins. In the crypto market, there's a truth that almost every trader must acknowledge. Bitcoin is always the market-leading asset. Whether you trade Ethereum, Solana, or any altcoin, Bitcoin's short-term price action directly impacts the entire market. In today's video, we'll analyze a very important time frame. Specifically, when Bitcoin rises or holds its price. Well, Ethereum reacts more slowly, and altcoins like Solana fluctuate strongly in line with BTC. Understanding this mechanism will help you better read the market in each short-term phase. BTC, the heartbeat of the market. Bitcoin is not just the largest coin. It's also the heartbeat of the entire crypto market. In short time frames like 60 minutes, BTC dictates market sentiment. BTC influences margin trading. BTC triggers or deactivates derivative orders. When BTC stabilizes or rises slightly, the market tends to reduce selling pressure, increase risk appetite, activate capital flows into altcoins. Conversely, when BTC falls, altcoins often react more strongly. Massive liquidation of positions occurs. Therefore, every movement of BTC in the 60 minutes is leading. Scenario 1. BTC rises or stands well in the case of a slight increase or sideways consolidation in Bitcoin. Market sentiment turns positive. Investors begin to become more confident. Reduce defensiveness, increase altcoin trading. Money flows. Spread money flows usually follow this order. BTC, ETH, large altcoins, small altcoins. 3. ETH reacts slower than BTC. Ethereum usually rises after BTC, with a smaller amplitude in the initial phase, then accelerates when BTC stabilizes. The reason is that ETH is still affected by the following BTC psychological effect. Altcoins, SOL and others. Altcoins like Solana usually do not rise immediately, have a delay of 10-30 minutes. But when it rises, the amplitude is stronger than that of BTC and ETH. This creates a late but strong effect. BTC rapid rise. If BTC rises sharply in 60 minutes, phase 1, BTC leads the wave. BTC breaks out or accelerates, volume increases sharply. Market sentiment quickly shifts to FOMO. Phase 2, ETH reacts with a delay. ETH rises but more slowly, usually lags behind BTC by 1 step. Phase 3, altcoins surge. Last SOL and high beta altcoins react most strongly, but they are also easily swept back if BTC stops rising. This is the phase. BTC pulls, ETH confirms, altcoin amplifies. Part 4. Scenario 3. BTC holds or moves sidewalking. When BTC moves sideways in 60 minutes, market volatility decreases. BTC does not create a clear direction. Volatility decreases. ETH begins to test the reaction. ETH may rise slightly or fall slightly, but there is no clear trend. Altcoins are highly volatile. Some altcoins are rising individually. Some are falling due to outflows. SOL is generally more volatile than ETH. This is the phase. The market is waiting for BTC to decide its next direction. BTC falls. When BTC falls in 60 minutes. First reaction, ETH falls along with it. ETH usually falls faster than BTC in percentage terms. 2. Altcoins fall more sharply. SOL and high beta altcoins fall the deepest. Margin liquidation occurs frequently. Domino effect. BTC falls, ETH falls, altcoins are heavily sold off. Here's why. Altcoins always amplify BTC's volatility. Conclusion. Money flow analysis. In the 60-minute time frame, 3 important principles can be drawn. BTC is always the market-leading asset. Ether reacts later but is more stable. Altcoins react most strongly but carry the highest risk. Understanding. This relationship helps you avoid placing orders against the trend of BTC. Know when altcoins are allowed to run. Avoid being swayed by short-term fluctuations. In crypto, not all coins lead the market. Bitcoin is the original signal. Thank you for watching the video.